Hey guys, Daniel Gonzalez here, owner operator, DWG Insurance Services Inc. Wanted to get on, and I felt like it was necessary to shed some light on what's going on with the current state of the market for the insurance industry. I know that a lot of you have maybe heard about the announcement from State Farm and Allstate and their decision to not offer homeowners insurance in California anymore for new business customers. That's really sparked a lot of conversation recently, which is a good thing, but this is something that we have been dealing with for well over a year now. It's just finally getting some traction, in the public's eyes and some news coverage, which again is a really good thing. Product availability has been down by over 50% in comparison to 18 months ago. Really, what that means is if you're a new customer looking for insurance, you have less than half as many options as you did about a year and a half ago. And that's what we call a hard market cycle for the insurance industry. So, just like normal industries or any other industry, we have cycles, hard and soft cycles. We're in one of the hardest cycles for insurance that really anyone has seen in the last 30 years or so. So, how did we get here? Well, it's a combination of a few different things that I want to go over. One of them is going to be supply chain issues and cost of materials being increased, right? So 2020, global pandemic hit, and through the next year to 2 years, we actually, everyone noticed supply chain issues for lack of supply from the factories overseas to the lack of available labor here in the States. Everyone saw the issues that created. A lot of people were laid off. So this cost many industries millions, if not billions of dollars in added costs that they weren't expecting. Insurance was no exception to that issue. Homes still needed to be repaired. People were still having losses in their houses due to water, fire, whatever the case may be. And in some cases, we saw lumber skyrocket to up to 300% the projected cost during a rebuild. And that's really hard for insurance companies to try to predict. We have some safeguards and policies, extended replacement cost, which I can get into in a different video, but there are protections there in place, but nothing like we saw here for the 2020 to 2022 period. So that was one thing. Claims are just costing a lot more than they have in previous years. The second thing, kind of tying into that first one, is reinsurance costs have all gone up as well. So reinsurance is essentially, in a nutshell, insurance for the insurance companies. If a catastrophic loss were to occur, there's no way that these insurance companies can pay all of that out at once. If California just burned 25% of the whole entire state, caught on fire, that would be a catastrophic loss. So these insurance companies take out insurance on themselves in case of that catastrophic loss. And these reinsurance companies have also increased their rates just due to the nature of exposure, the amount of customers that are flying in or coming in on the new business side for these carriers, and the increasingly severe fire seasons that we have in California have all increased the reinsurance cost for the insurance company. Now, as the reinsurance costs go up, typically they do pass that cost on down to us in the form of rate increases for our personal policies, right? Total normal cycle or normal way of things to operate. Which brings us to number 3 of the reasons why we're kind of in this situation. There has been a lot of state restrictions on rate increases. So most states, or all states, I believe, operate under the Department of Insurance for that state. The Department of Insurance tells insurance companies when they can take rates, how much they're allowed to take rates, the rules and regulations in which they hold their customers to. This is all in the goal to protect the consumer, which of course is a good thing. Unfortunately, California, I'm only speaking to, has seen it fit to not allow any rate increases from these insurance companies that are residents in the California state. They have just not allowed the insurance companies to appropriately take rate for the rising costs and all the other reasons. Because of the pandemic, a lot of people getting laid off, financial issues, they have decided that, they've basically declined all the rate increases for the last 3 years. Now, rate increases are a healthy part of any industry. Inflation, obviously, as we saw the last couple of years, is prevalent. So, without being able to take the rate increases, with the reinsurance costs going way up, the cost of claims also going up, companies here in the state have just stopped being profitable, and that is the main reason why we're seeing a lot of these carriers go, I'm just not going to play in the state then if I can't take proper rates. So, unfortunately, we do expect this to get worse. We've already seen some companies just reactively decide to pull out because of the big players, the big names coming out of the state of California. So we do kind of predict this to go into 2024, maybe even 2025, depending on what the state of Department of State of Insurance does and whether or not they allow some emergency rate filings. The good news, not to sound morbid over the last 6 minutes, is that we are still open, we're still operational. As a broker, we're not limited to or loyal to one singular company. So we still have many, many options for homeowners here in California, as many as there are available at least, right? So we're always going to be looking for the most competitive, the best deal for the coverage. And we're still finding a lot of success and helping a lot of customers, right? We hope that it lessens up soon as far as getting more product availability, but we're always working to still provide that top-notch service. So if you have any questions, hopefully this explained a lot. Any of my referral partners, I'm sure you've had a lot of questions. Please give me a call, reach out today. Happy to help. Appreciate you guys. Good luck.